Alright, hey, what's up guys? Scott here again with a new live trading video. Today is Friday, June 8th, and for this video here, I'll be giving you guys a very detailed live demonstration of the ratio spread option trading strategy. And so in particular here, we'll first begin with some basic analysis on the charts here so you guys can see my general thought process behind when might be a good time to make this kind of trade. And then after that, I'll be actually making the trade on Amazon. And then finally, we'll take a look at the risk profile of this trade, and I'll basically be discussing the pros and cons of using the strategy. Now, real quick though, make sure you guys watch until the end of the video, because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks, and each stock could be worth up to $2,500. And then also, if any of you would like to join a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. And once you join, you'll gain access to the following great benefits. Number one here, you'll see detailed real-time trading updates from my personal live trading account. You will also receive daily trade suggestions and ideas, alerts regarding important market news, events, and price levels. You will also receive very fast and personalized responses to any and all of your questions. And of course, also, you'll be able to participate in very engaging discussion with other like-minded traders and investors, myself included. And so if that sounds good to you, then be sure to sign up today using my link that you'll find in the description of this video, and you'll begin your 7-day free trial. And then finally here, for those of you who are brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Alright guys, so now diving in here, and first off, there are two different forms of the ratio spread. Basically, there is the put ratio spread, and then also there is the call ratio spread. And basically the main difference between the two is simply the directional bias that you want to have with each different kind of position. So for the purpose of this video here, I'll be showing you guys a demonstration of the put ratio spread, which is mostly a bearish trade, but if you guys do want to be bullish with a ratio spread, then simply use call options or a call ratio spread. So basically, with the exception of your directional bias when making a trade, everything between the call ratio spread and the put ratio spread is exactly the same. And so now first off here, let's take a brief look at SPY, which is a major ETF that tracks the S&P 500. And we'll go ahead and zoom in here on the chart a little bit. And so my preferred usage of technical analysis is pretty simple. I mostly just use support and resistance levels, which for SPY here, as you can see as of yesterday, SPY has reached, as what I see, a major resistance point. And today, in fact, we are seeing perhaps the beginning of a reversal in the market. So essentially what this is telling me is perhaps I do want to make a bearish trade to play for a continuation in a downside reversal in the market. And so therefore, if we now come over to AMZN or Amazon, as you can see here, Amazon has also reached a pretty major resistance point right around 100 and call it $17 per share. And just like SPY, it looks like today Amazon might also be getting repelled off that point. So therefore, as I said, I might want to make a trade today to play for a continuation of this reversal, perhaps until Amazon gets down to a price of maybe 105-ish bucks per share, right? Because at around this price point, I could see Amazon finding support once again. So essentially, it's mostly in these types of situations where you basically want to play for a smaller move in one direction or the other that are great scenarios for using a ratio spread strategy. Right, because as you're going to see here, ratio spreads are great for maximizing profit potential for a smaller move in your favor, but also one of the great advantages as well is you can still make money even if you are completely directionally wrong as well. And so now at this point, let's go over to the trade tab and take a look at the option chain for Amazon. And for this trade, we'll go into the August monthly expiration cycle with 42 days left to go. Unfold that tab here, and then we'll scroll down to the near at the money options. Now the ratio spread here, specifically the put ratio spread, is a combination of two different strategies together, and that is a combination of the put debit spread as well as a simple short put option. And so essentially for this trade here, I'm going to purchase the 112 strike put option, which right now with Amazon at around 115 bucks per share is only a little bit out of the money. And then also I'm going to sell the 105 strike put option. And basically that's the first step of putting on the ratio spread, right? Because in this case, what I've explained so far is simply a put debit spread. I buy a put, I sell a put, that's a put debit spread. But then also as the second component of this strategy, I'm also going to sell an additional 105 strike put option as well. So essentially, to summarize here, I'm going to buy one contract of the 112 strike put, but I'm going to sell two contracts of the 105 strike puts. And thinkorswim here also has a very easy way to create this whole trade at once. So what I'm going to do is right click on the 112 strike put option and then go to sell and /ratio. Click on that. And here we go. As you can see here, this is one order to purchase one contract of the 112 strike put option, and then at the same time sell two contracts of, I'll change the strike here, of the 105 strike put option, which is all the way down here. There we go. Now the cool thing with this strategy is, as you can see here, for making the trade, I'm going to receive a credit of about $120. And this here is a very, very important part of the ratio spread, because by receiving a credit when putting on the trade, this is what allows you to still make money even if you are completely dead wrong on the direction of the trade. So as I showed you on the charts there a moment ago, I want Amazon to come down a little bit in price. That's how I'll make the most money. But if Amazon continues to push higher and higher, I will still make money on the trade. It'll be less money, but I will still make a profit. So just make sure that if you do want to trade the ratio spread here, just make sure you always construct the trade such that you are receiving a credit when entering the position, not paying a debit. And so everything looks good here on this order. So I'll go ahead and lock in this price, which as you can see here, the credit is dropping a little bit because Amazon is moving higher currently, but that's fine. Still collecting a nice credit here. So we'll go to confirm and send. And then also real quick, take note of the buying power effect for this trade. Right now, it's about $1,400, which is pretty hefty, mostly because Amazon is a somewhat expensive stock. But also keep in mind that this strategy involves selling a naked put option, or at least a cash secured put option. So therefore, as you're going to see here, this strategy does have some added risk. Although to compensate for that, it's also going to have a very, very high chance of making a profit. But at this point, the risk here on this trade is still fine, well under 5% of the total account value, which is where I want to be. So we'll go ahead and send the order. And still no fills yet on this order, so I'll come back to the monitor tab and perhaps change my price a little bit. There's my order. I'll right click here and go to cancel and replace. And perhaps I'll come down to maybe $110. Confirm and send and send. And there we go, just got filled at 105. Had to come down a little bit more in price there. But there we go, I'm now officially in this position. And then lastly here, we'll come over to the Analyze tab and take a look at the risk profile of this Amazon ratio spread. And so as you can see down here, this is my actual position, right? Short two contracts of the 105 strike put option, and then long one contract of the 112 strike put option. And what you can see in this diagram is the actual risk profile, or basically the payoff diagram of that exact position. And what's most important here is the line in blue, which is my profit diagram by the actual expiration date. Whereas the one in purple here, this is the payoff diagram as of today. So again, we'll mostly focus here on the blue curve. And so as you can see down here with the x-axis, these numbers represent the possible prices for Amazon. So currently you're seeing a possible range of $80 per share all the way up to $140 per share. But currently, the actual price of Amazon today is right here in the middle with this dashed line at right around $116 per share. And then finally, with the y-axis of this chart, this will show you your profit or loss by the expiration date on this position based on a given price for Amazon. So even right now with Amazon at around $116 per share, if today was the actual expiration date, you would still make some sort of profit on the trade. And specifically, as you can see down here with this blue number, that profit would be exactly $105, which of course is the initial credit that I collected when I put on the trade just a few moments ago. And you still will make that exact same profit if Amazon is anywhere above a price of exactly $112 per share, which again is your long put strike. So again, as long as Amazon is anywhere above 112 by expiration day, you will make $105 in profit, guaranteed. And that's one of the very cool things about this strategy, right? Even though I want Amazon to go down a little bit in price, even if that does not happen at all, and Amazon simply goes higher by the expiration date, doesn't matter. I'll still make some sort of profit. But obviously here, if I am correct on the trade and Amazon does actually decrease in price a little bit, then this zone is where I'll make the most amount of profit. Specifically, if by expiration day, Amazon is right around $105 per share, which again is my short strike for my 2 short put options, then in this case, I'll make the most amount of money, which is roughly around, call it $800 or so on the y-axis. Or again, looking down at the blue number here, you can also see that yes, indeed, the max profit on this trade is right around $800. And that's good because like I showed you on the charts, we'll come back here real quick. As I showed you, I do think Amazon could come down perhaps to a price of around $105 per share. So therefore, as you can see here, I was careful to construct my trade such that I would make the most amount of profit if I was the most amount correct on this trade, right? If Amazon does reach my profit target, I will make the most amount of money. Now, of course, also Amazon can still drop further and I will still make some money on the trade as well. So if we come back to the Analyze tab again here, you can see that outcome reflected in this zone right here on the payoff diagram. So ultimately, if by the expiration date Amazon is anywhere above $97 per share, I will make some amount of money on the trade, right? So this small red dash right here, this is my break-even point on the P&L diagram. So therefore, if Amazon finishes below that price level, I will begin to face some losses on the trade. And because our ratio spread here does involve a simple naked put option or a cash secured put option, you do have naked downside risk. Right, so basically the further Amazon drops below your break-even point, the more and more money you will lose. But that being said, what is the chance or the actual probability of Amazon finishing below your break-even point? Well, what I can do is take this left dashed line and simply drag it over and match it with that exact break-even point. And now as you can see right here with this percentage, this is the actual probability or the chance that Amazon finishes anywhere in this area, or basically just below $97 per share by the expiration date. So essentially, if there is only about a 20% chance of Amazon finishing below $97 per share by the August expiration date, then that means there's about an 80% chance of Amazon finishing anywhere above that price. And because this trade here allows you to make money anywhere above that price, that also means you have an 80% chance of making money on this trade. That's very, very high. So again, even though you do have naked downside risk with this ratio spread, and you could lose a lot of money if things go really, really wrong, you still have a very, very high chance of that never actually happening. So this here is one of the greatest advantages of the ratio spread or really any options selling strategy. You will always have a very high probability of making a profit. Now that being said, to address the possibility of losing a lot of money on this kind of trade, in my opinion, it makes the most sense to use the ratio spread on a stock you would not mind potentially owning in the future. Right? So for example, if Amazon did have some kind of catastrophe and it did fall a lot by the expiration date, well, at that point, you will get assigned on your short put option and you'll have to purchase 100 shares of the stock. And so ultimately having to own 100 shares of Amazon, a very quality company, right? And which is likely to recover at some point in the future, obviously things could be worse. So again, if you do use the put ratio spread on quality stocks that you would not mind owning anyway, if at some point you do get assigned on your put option, then in that case, the naked downside risk with this strategy is not a huge deal. And also, of course, don't forget that if you do get assigned on your put option, you will still get to keep the initial credit that you collected when first putting on the trade anyway. And then finally, in regards to the call ratio spread, right, which is just the opposite of the put ratio spread here, it's mostly meant to be a slightly bullish strategy, but that is definitely a bit more risky because in that case, you are going to be selling some naked call options. And because, of course, there is no limit as to how high a stock can go, that's why, generally speaking, selling naked call options are more risky than selling naked put options. So if you are going to use the call ratio spread, then perhaps make the call debit spread portion of that strategy very, very wide. So therefore, your short call option is very far away from the current stock price. And then also only trade it on stocks that are not very volatile and therefore are not likely to see large price swings in the upward or downward direction. And then also the last thing I want to mention about these strategies here is you don't also have to wait until expiration to take your profits or your losses, right? Even though in this case with the blue line here, you'll make the most amount of money, the maximum profit potential on the actual expiration date if Amazon is at 105 per share. But let's say maybe a week rolls by and Amazon already falls down to that price, then this position here will still be very profitable. It just won't be the most profitable. So ultimately, if at that point your profits are still satisfactory, you can still take off the trade and book your profits and not have to wait all the way until expiration date. So just keep that in mind. And so that's going to do it here for this video. I hope you enjoyed it. But one last thing, as I mentioned, I do have a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you sign up for a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and sign up for my options trading Discord as well as my SKILLSHARE courses. Links also in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.